Here's what's coming up on today's show.
The real question is, how much safe money does anybody need?
Yeah.
And where does that safe money play a role in the overall financial design of your portfolio?
Welcome to the How Money Works podcast with Craig and Jennifer Moser of Maestro Wealth Advisors, serving you throughout the Triad of North Carolina for more than 30 years.
Well, let's dive in and have a little conversation here today about some safe money. I guess we'll just kind of start it, guys, with everybody has different definitions of that term, right? And with everybody being able to call themselves an advisor these days, you know, it gets a little confusing. So I guess what are some of the different ways that you guys see people defining that term?
Well, you put it a different way. It's an overused phrase anyway.
Okay.
You know,
right.
I hear the radio and half the guys on the radio, safe money advisor. And I'm like, okay, do you have liquidity? That would be an argument. But for me, the definition of safe money is money that will not lose principal, money that can earn some interest.
Right.
But the first part's more important than the second because, you know, who was the guy that said, don't tell me about the return on my money, but give me the return of my money?
Was it Will Rogers, I think?
Yeah, one of those guys.
Yeah, one of those guys.
And so I'm like, I've always kind of thought about that. And in the right, proper design, safe money is important. You know, it's things like CDs, fixed annuities that just pay interest rates, money market, safe, you know, stuff that's not going to make you a whole lot of money, but it's there and it's liquid, which is a key phrase there.
Right.
You know, some guys throw in the fixed indexed annuity as safe money. You know, here your principal can be safe, but you can't be sure that you're going to earn a return, but usually over time you do. But, you know, those are all things that have no downside risk. I prefer access to capital if I was going to define safe, but okay, you know, I can hear the difference. So anyway, you asked for my definition, I defined it.
Well, I didn't ask for your definition, but I asked why people get confused, but I was going to ask you your definition, so thank you for defining it. Jen, do you agree with that, or do you kind of feel like people, what do you think people get the information to kind of use that term from, just from stuff they hear?
I think it is from what they hear. And you know, you turn on the TV, you listen to the radio, you pull up a publication, and people are always pitching their particular idea. I mean, people think, you know, gold is the safe thing right now because it's going up, and it's always there. And, you know, people...
They can touch it.
Yeah, they can touch it, and it's nice and shiny, and they've got this, you know, endorsement from whoever, you know, saying that it's great. I agree with Craig. I mean, people define it in different ways. I think not going down is a key factor for people thinking of safe. The real question is, how much safe money does anybody need?
Yeah.
And where does that safe money play a role in the overall financial design of your portfolio? Because you can be safe and go broke with inflation over time.
So is that really safe?
Right.
There's the argument.
So there's never been one, there's no one investment that can give you all the growth, can give you the inflation, can never go down, can always be there, is always liquid. There's no one investment that can do everything. So it's important to compartmentalize your investments and have different segments do different things for you.
You know, I was going to say all that, but you just took it from me.
And I said it much more succinctly.
I think so.
Oh, succinctly even, yeah.
Ow.
Nice.
That one actually kind of hurt a little bit.
So how do we guide, Craig, you know, as the listeners to say, okay, yeah, safe money, and I do want some, and we think everyone should have a little bit of that. As a certified financial planner, being in the business for 30-some years, when you go and you sit down with a client, there is a certain amount of money that you want to put in safe and liquid, and then other pockets. Let's talk about the design of someone's portfolio.
So let's think about somebody that's not ready to retire. Let's do that one first.
Okay.
So you're 45, you've got 15, 20 years to plug this money in. Getting a plan to save is very important. But key phrase, you need to have some safe money. Some money typically in a money market type of account, highly liquid, earn some interest. I can access it, meaning you, at any point in time for the emergency fund, because I promise you something's going to happen. You'll go into the room and you'll look up and there's a leak in the roof. You'll crank up the car, but it doesn't crank. You'll go, man, it's awful hot in this house, and you go out in your heat pump, done pumped. I mean, it's finished.
Right.
So you've got to look at all this and say, I need some money back for the stuff that will happen. But if you put too much there, Jennifer already said it, you lose track to inflation. Inflation eats things up. Think about how much things cost today. And if you're, say, in your early 60s, let's use that nicely. If you're in your early 60s, what did things cost after you got out of college or after you got out of high school? I mean, man, 35 cents for gas. I remember that being the price for a gallon of gas, and they washed my windows and checked my air pressure on my tires and the oil, for that. But today, a lot different. Things cost more. So you have to have everything bucketed in a certain way. So for the younger person, you have time. Time is your friend at this point. So the volatility, and I hate to say what I'm going to say, but especially the down volatility is your friend if you're a systematic saver. So most people that work for a corporation that has a 401k, they're putting money in probably twice every month. And so they get a chance at whatever the price of a volatile investment might be. So if the price is really high this month, which it happens to be, you will buy less shares. But if the price is lower, say like it was in April when we first had this tariff scare, you were buying some assets at a bargain price. So systematically saving, that's the way to do it. And so I don't know how I got off on this, but what I'm trying to say is it depends on where you are, how much you need to have in safe stuff. But you also have to have the growth ideas for down the road. If you have something that can earn over a 5-year investment window, which is really what you should be measuring by, not quarter to quarter, if you can earn double digits on that's going to get you a long way if you have time for that money to work for you. If you're always bobbing and weaving and dodging and trying to hit the thing, and if you miss, you lose money. Don't invest that way for the biggest part of your savings. You can do some if you want, but the truth of it is you need to have a plan. How much do I need to save to get me where I need to be, and what's a reasonable rate of return to get me there, and have some safe money.
And Craig, you were talking about for the younger investor and buying into those dips and the accumulation phase, and systematically investing in that accumulation phase. When you're getting ready to retire, though, there needs to be a different mindset that a lot of people really don't realize, that it truly is a different stage of life. And now you're basically taking that accumulation bucket. Some of it's going to be safe, some of it's going to be invested, and then they got to turn an income stream on it. And their volatility is definitely not your friend.
No, when things go down and you pull money out of an investment and it's down, it's a double whammy. Say you pulled out $5,000 out of a $250,000 account, and it was April when it went down 17-20%. You lost that money because you don't have a steady flow of returns in a volatile account. It goes up, you're really happy. It goes down, you get a little nervous. You need to restructure and say, how much do I need for the next couple of years? That shouldn't have any volatility to it, because if you need it, don't mess with it. Put it in something that you can go get. You have a reasonable rate of return on it with almost no risk. You can put money out for 3, 4, 5, 6, 7 years in things that churn a lot of cash flow, a lot of interest, a lot of dividends, a lot of income. And those things, that is your replenishment account if you do it well.
And that was a good segue, because before this segment ends, Craig, let's talk about safe money. And there is the traditional, people have come, let's talk about some clients that have come to us that have had $300,000 in safe money at the bank or a CD. And we talk to them, it's like, okay, what are you earning on that CD? Well, that CD is taxable, right? So you receive this amount of money, but then at the end of the year, you're in a 22% tax rate. How much of that money did you actually keep?
Right.
Can we shift those dollars and not having a taxable safe investment, quote unquote, but maybe move it into something else, tax-free bonds, other income ideas that you we've introduced with our clients to basically keep more of what you get?
That's right. That's why I married her, folks, because she's smart. But the reality of this is we did that just the other day. We had a client forever. I mean, school teacher, we're sending in cash flow. She gets her pension. She's got her Social Security. And, Jennifer was redoing the analysis, because about every 2 years we go back and say, hey, we said we needed to be right here in your journey. Are we there? Are we better? Are we worse? And what happened if we're not where we need to be? And she goes, when she was looking at it, she said, "My gosh, you got like $400,000 or $500,000 sitting at the bank. How come?" Well, I didn't spend all that was coming in, and I just kept squirreling it back and squirreling it back. What's that earning? 3 or 4%. What does the government take? Well, it was a good time to ask because she had just filed her taxes, and the tax hit on that was
pretty sizable.
Yeah, I mean for a single. And so anyway, easy move. We left some in there, but we put money in a tax-free bond portfolio. Now the interest that she earns, not taxed.
Right.
Very easy to handle.
Thank you so much for checking out the podcast today. If you have any questions about what we've discussed, remember, you can get a complimentary financial review with the team at Maestro Wealth Advisors by calling 336-448-1086 or go online to howmoneyworksradio.com for other great resources and ways to reach the team. You can also check the show notes of today's episode for our contact information as well. And don't forget to subscribe to the podcast on your favorite app so you never miss an episode. We're on Apple Podcasts, Spotify, Google Podcasts, and all the most popular apps. For Craig and Jennifer Moser, I'm Mark Killian. We'll talk to you next time on the How Money Works podcast.
Craig Moser is a financial advisor and certified financial planner. Securities offered through Avantax Investment Services, member FINRA SIPC. Investment advisory services offered through Avantax Advisory Services. Insurance services offered through Avantax Affiliated Insurance Agency.